Great. It's great to see everyone. We have our next presenter, which is Flushing Financial, and we have John Burren, the CEO, along with Susan Cullen, the CFO and Treasurer, and Al Savastano, the Investor Relations Specialist. Flushing is an old friend to people investing in the Northeast banks. In fact, it's been around since 1929. So it's quite an old friend. And we had a great conversation, and there's a lot of interesting things going on with the bank, and we really wanted them to present, and I'm glad that they are here. So it's a New York City, for those not familiar, it's a New York City and Long Island franchise approaching $6.5 billion in deposits. They've deployed fintech and niche strategies, which I hope they'll talk about. Without any further ado, let's turn it over to the Flushing team. Thank you.
Thank you. Thank you. Great to be here. I want to thank everybody for joining us and for our conference presentation. I'm John Burren, President and CEO of Flushing Financial, the parent company of Flushing Bank. I'll provide a brief overview of the company along with key growth initiatives, and then I'll turn it over to Susan Cullen, our Chief Financial Officer, to really review the financial trends. And then following our prepared remarks, we'll answer your questions. So we can quickly go up past slide 2. It's our safe harbor statement. I'm sure you've seen a number of these over time. Please read it at your leisure. Slide 3 gives you an overview of the company. Flushing Bank's a leading community-focused bank with assets of $8 billion and 25 branches, mostly in the boroughs of New York City. We focus on real estate lending to borrowers of rent-regulated multifamily apartment buildings and everyday use of commercial real estate that's central to the local communities. So these are assets like medical offices, strip malls that people use on a day-to-day basis. We also have a commercial business portfolio representing 22% of the loans. Loan portfolio, the bank employs very conservative underwriting standards that leads to a very low risk loan portfolio that has outperformed the industry over the long term. The bank's markets are multicultural, and we serve them by speaking over 20 different languages. One of the largest segments of our footprint is the Asian market. This group represents about 15% of the bank's deposits, and it's one of the primary areas of focus for our marketing. All of this is translated into returns for shareholders over the long term. The stock has outperformed the returns of the S&P 500 and peers since our initial public offering in 1995. Most important is culture. Our brand promise is rewarding relationships as we build relationships with investors, communities, customers, employees, and of course, regulators. We believe that this is the primary focus of a community bank. If you go to slide 4, this outlines a very significant opportunity for our company, and that is the merger disruption that's occurring in our markets. There have been 10 recently announced or closed mergers in our markets that comprise 27% or $87 billion of deposits in our footprint. Since March 31st, 2021, we've hired 42 people, including 18 revenue producers from institutions that are involved in a merger in our markets. In the second quarter, we hired 12 people, including 6 revenue producers. The M&A activity in our market is in various stages of integration, and we expect to add more people and profitable banking relationships as conversions occur, strategy change, and disruptions change within the market. Given this environment, we expect to remain focused on the organic growth opportunity in front of us for the present time. If you look at slide 5, you see one of the results of some of this. Loan activity increased due to several factors, one of which was the merger activity, the other of which is this just the general movement of the economy in New York City upward. The pipeline that you see here on slide 5 was a record last quarter and is the second highest level in our history this quarter. Loan closings accelerated to a record $504 million. And the second quarter, in the second quarter, and the pull-through rates have really returned to our normal levels after bottoming out in the third quarter of 2021. Given the significant move in rates, loan closings could start to slow, but satisfactions, of course, will probably, which had remained elevated in the past, should start to decline. Slide 6 depicts some of our growth in our digital banking platforms as customers have really embraced our digital offerings. We continue to see high growth rates in monthly mobile active users, online banking users, and digital banking enrollment. The Numerated platform, which we feature here, helps us digitally originate dollar loans as quickly as 48 hours. This continues to grow. We originated approximately $11 million of commitments in the first half of the year with a weighted average yield of over 6%, adding over 30 relationships. We continue to explore other fintech offerings and partnerships as we continue our view of digital offerings. The second quarter had several important events to highlight. As you can see on slide 5, we opened a new branch in Elmhurst, Queens, which expanded our Asian market footprint. This branch is staffed by employees who were previously with one of the banks involved in a merger that we just spoke about. Growth and activity in the branch has exceeded our expectations as a result. We also signed a lease to open a branch in Hauppauge in Suffolk County on Long Island. Hauppauge is one of the key business centers on Long Island. The company issued its inaugural environmental, social, and governance report, and our complete checking account product recently received Bank On certification. We participated in many community events this quarter, including supporting the United Way, New York City Rise, and Neighborhood Housing Services of Queens. Importantly, Flushing Bank employees completed a very successful food drive for Island Harvest, and also participated in Brooklyn's Cinderella Project to provide prom attire for young women and men. These events are very important and demonstrate how Flushing Bank supports our communities and how the bank lives its brand promise of rewarding relationships. I'll now turn it over to Susan to provide more detail on our key financial metrics. Susan?
Thank you, John. I'll begin on slide 8. Growing non-interest-bearing deposits is a priority for us. Average non-interest-bearing deposits increased 13% year over year and comprise over 16% of average deposits compared to 8% in 2018. Our teams continue to open new checking accounts, which were up 18% year over year. The growth in non-interest-bearing deposits is helping to mitigate the overall rise in deposit rates. Deposit costs have increased 8 basis points to 29 basis points in the second quarter compared to 32 basis points for 2021. Slide 9 outlines the loan portfolio and yields. Net loans, excluding the PPP loans, increased 2% for the first 6 months of 2022. With the exception of the PPP loans, which continue to be forgiven, loan growth was broad-based with commercial real estate and business banking loans both growing. As John mentioned, the loan pipeline of $583 million is up 36% for the first 6 months of the year. Core loan yields increased 10 basis points in the second quarter compared to 2021. The loan portfolio is well diversified with the average real estate loan less than $2.5 million, strong debt service coverage ratios for the multifamily commercial real estate portfolios, and no significant concentrations in the business banking portfolio. Additional details are provided in the appendix to our presentation. Slide 10 provides more detail on the repricing of the loan portfolio. We have nearly $1 billion of loans tied to short-term rates and will reprice at least twice in 2022. Approximately $320 million of remaining dollars of the remaining portfolio reprices through the end of the year. An additional $982 million of loans will reprice in 2023. Through the end of 2024, loans are expected to reprice 113 basis points higher based on index values as of June 30th. While we expect the loans to reprice at the contractual rate, repricing will depend on the then current market rates and competition. Indices have risen as the Fed increases rates, causing repricing rates to move higher. Our loans will reprice over a longer period of time, and that is why it's imperative that we manage our deposit repricing. Slide 11 outlines the net interest income and margin trends. The GAAP net interest margin was 3.35% in the second quarter compared to 3.24% for 2021. The core NIM was 3.33% compared to 3.17% in 2021. Net interest income increased 2% quarter over quarter to a record $65 million in the second quarter. Core loan yields rose faster than core deposit yields in the second quarter. This rate cycle has been different from the past cycles given the pace and magnitude of rate moves. While we did a good job of maintaining the net interest margin to date in the rising rate cycle, it may become more challenging given the outlook for Fed increases. Moving on to asset quality on slide 12, we have a long history of strong credit quality, primarily due to our low risk credit profile and conservative underwriting. This has served us well through many cycles. We had net recoveries in the quarter of 3 basis points, and the average loan to value in our real estate portfolio is less than 38%. We stress test the portfolio for increases in interest rates and operating expenses. Based on these stress tests, debt service ratios remain over 1%, meaning borrowers have enough capacity to make loan payments even under stress scenarios. Slide 13 provides additional credit metrics. Asset quality is a hallmark of the company. During the second quarter, our non-performing assets rose to only 59 basis points of assets. The increase is primarily from 3 relationships migrating to non-accrual. We view these items more as one-offs rather than fundamental portfolio issues. Our criticized and classified loans remain stable and our reserve coverage remains strong. Our capital position is depicted on slide 14. With rising rates, the value of the securities portfolio of most banks decline, and this negatively impacts book value and tangible book value per share. The company's strong earnings and the size of our investment securities portfolio allowed book and tangible book value to increase to year to date and during the second quarter. The bank returned 71% of earnings to shareholders through dividends and share repurchases in the first half of 2022. During the second quarter, the board of directors increased the share repurchase authorization by 1 million shares. Going forward, we will balance share repurchase activity with our internal goal of an 8% tangible common equity ratio. With that, I'll turn it back over to John.
Thank you, Susan. On slide 15, we wrap up with our key messages. Loan growth was positive in the second quarter as strong pipelines resulted in originations greater than satisfactions. We expect loan growth will remain in the low single digits for the remainder of the year. Company did a good job of managing interest rates in the first half. The pace of magnitude of rate increases in this cycle will make that more challenging in the future. Over the short term, net interest margin may decrease, but over the longer term, it is expected to rebound as a result of our loans repricing. We'll see some mitigation on that, as Susan outlined earlier. Given Fed projections, we expect to lag deposit repricing in the short term. Flushing Bank has a long history of superior credit quality, driven by our conservative credit culture. We have a low-risk loan portfolio as proven by the high percentage secured by real estate, low loan-to-values, and high debt service coverage ratios, even in stressed environments. We're well prepared to handle any potential economic downturn affecting the credit markets. We've been attracting business and talent as we added 42 people from mergers, 18 of which are revenue producers, and we expect this to continue. Capital return was 71% for the first half of the year, and while book and tangible book value per share increased, rising rates impacted tangible capital ratio levels slightly below our internal target. Going forward, the company will balance the capital return with the desire to increase the tangible common equity ratio. The stock has an approximate 4.3% dividend yield. Overall, the company performed well versus its through the cycle return on average assets and return on average equity goals in the second quarter. Ian and Julianne, I'll turn it over to you to open it up for questions.
Great, thank you very much. Informative. Yeah, there's again, attendees, you could use the Q&A box to write in your questions, or you could raise your hand and we'll call on you. Here's an interesting question. You seem to have great results here. Everything looks fantastic. But your multiple on book is relatively low. Are you getting a sense out there of what the investment community there seems to be a dislocation between the two? Is there something that's a misperception out there, or something that investors are worried about? Could you comment on that?
Sure. So I think the company has performed well during both the pandemic and clearly post the pandemic. Last year we posted record earnings. We are liability sensitive in a rising rate environment, so I think that may play into it. But I think that there's a general lack of understanding that we do have a loan portfolio, as we outlined in the presentation, that catches up fairly quickly. So I think you start to see the impact of that with the $900 million or so that we have, or 46% of the loan portfolio actually, that is going to reprice through 2024. So I think that people who understand the company a little bit more and understand the structure of the balance sheet, I think will benefit, and those that don't will be surprised negatively.
Great, thank you. Another question, would you say that competition, excuse me, for deposits has been more intense recently compared with the second quarter? How do you expect to fund your loan growth? Also, maybe if you could, with that, kind of dovetail some of the things you were talking about, how you're approaching these niche markets and your successes there. I think there's a lot of deposit growth you talked about coming from those markets.
So I'll quickly answer the first question. Yeah, we are seeing competition. Competition is always heavy in New York. It's the epicenter of some of the largest banks in the world, no less the country. So that's something that we deal with all the time. So that we look at as pretty much table stakes that what we have to deal with. And clearly the competition for deposits continues to increase. However, we do have some really strong niches particularly in the Asian community, that, as we noted in our presentation, we just expanded into another branch location, and we're constantly looking at others as well. And the advantage to us there is that we get a real network effect from our community activities and the lending that we do in those communities. So, at 15% of the overall portfolio, we really feel that this is a growing niche for us. It started in the Flushing market per se, but has expanded into Brooklyn as well, and even certain areas of Long Island. So you really have a very strong economic engine within this market, and we're clearly a part of it. It's probably, when you look at the size of the market, it's probably bigger than the total deposits of many states. It is just a huge market, and we have a very nice position in it at this point in time, somewhere around 3% of deposits. So we're doing quite well.
So we have a hand raised, and I'm going to try to see how we work this, from Kevin Reevy. Okay, Kevin, if you could unmute.
Good morning.
Hi, Kevin.
Hi, Kevin.
With Elizabeth Park. How you doing?
Good.
Good, how are you?
How are you?
Excellent, excellent. So my question is, Susan, earlier in your prepared remarks, you talked about stress testing your loan portfolio, and your company has a I would say, a pristine and proven asset quality track record. Could you talk about some of the assumptions that you were using behind some of the stress testing of the loan book? In other words, what are the rate assumptions and what are the other economic assumptions that drives that analysis? Thank you.
Sure. So first we stress tested the expenses, and we took the operating expenses of the individual buildings up 10%. And then we also shocked the portfolio by 200%. And then we did a combination of adding the 10% and the 200 basis points increase in rates. And in all scenarios, our debt coverage ratio did stay above the 1% threshold. We also, for point of reference, we don't necessarily talk about it in our presentation, also shock our loans at origination. So in case there is a rate increase as well, we continually monitor and do annual stress tests on our portfolio.
Okay,
Thank you, Kevin.
great. We have another hand raised. So let's see how we do that. And
Actually, while we're unmuting,
yes,
David, there was a question about are there any loan exposures that you're more cautious about at this point in the economic cycle?
I mean, there are none in our portfolio that we think are issues, and we have a very well diversified portfolio. Multifamily in New York, of course, is a big part of our portfolio, very, very strong. The commercial real estate that we have is generally commercial real estate in neighborhoods, and it's really required for day-to-day neighborhood activities. So much of it really supports our multifamily portfolio, the tenants, let's say, within our multifamily portfolio. So there's really nothing that we don't have exposure to New York City office, Midtown Manhattan office, which I think is one of the question mark areas within our, within the New York metropolitan area, but we've stayed away from that.
Right.
okay, let's see if we can get David to unmute.
There we go.
Sorry, it was a mistake when I got my hand up. I apologize. I didn't intend it for it to be a question.
Oh, no question.
okay.
All right.
No problem.
So another question that popped up is you mentioned you have a 38% loan to value on the existing book. What are your parameters right now for loan to value that you're writing? And a corollary to that was the questioner was asking, it seemed like your loan growth could actually be faster than what it is given the pipeline. So I don't know if it's just you're being conservative or how is
So
that?
let me answer the second part first. The satisfactions remain very elevated in the first half of the year. With rates rising, we expect those to come down because our originations were very strong through the first half of the year. So it's a function of a lot of the function of the payoffs and the satisfactions. We still were running into a little bit of a glitch in New York City of courts not being open, lawyers being delayed, et cetera. So, we would expect, as we say in our presentation, loan growth to accelerate in the second half of the year. The LTVs on the portfolio we're seeing now are probably in the 50% range. Our policy is 75% LTV. We have very limited exposure to anything with an LTV quite that high. Those LTVs are based upon the LTV at origination, the denominators at origination. So as the loans have aged and we've built relationships, these continue to pay down, giving us that nice conservative 38% LTV.
Right. So given your valuation and how do you look at your capital management? You have a dividend yield that's 4. How are you looking at buybacks versus dividends? Maybe you give some color to your capital management.
So we have a long-term goal of an 8% TCE ratio. So we balance our long-term goals with our regulatory capital requirements coupled with our share repurchases and dividends. Our first priority with capital is to profitably grow the balance sheet and then return capital to the shareholders through the form of a dividend, and finally through the share repurchases. And our dividend ratio is, is generally in the 40 to 50% range.
Right, if I can just ask along those lines, your capital ratio, are you talking about the TCE to TA ratio, right? So it's around
Correct.
2% right now, but it's such a great opportunity to be buying the stock back below tangible book right now, and you do have mid-teens, if not higher, return on tangible equity. So you have some, I think you have, I think it's great
Yes.
you have the authorization in place. It looks like a great opportunity.
Yes. Agreed that it's a great opportunity.
Good. And one other question, how do you look at employee, and I think you look at a little bit different employee and management incentives and how are you attracting the right people or good people? How do you look at your whole staffing and incentives?
Sure. So, we have goals for, for individuals, individual loan goals, individual deposit goals. A little bit different than the last year or so. We put more focus on non-interest bearing DDA growth as central to everybody's everyone's incentive plan. So I think we've seen the positive impact of that. And then top management really gets incentivized by the return on equity and hitting our budget.
Well, we really appreciate.
I'm sorry, there was just one question in the chat that I think didn't get answered. Can I just ask it real quick?
Yeah, because we
says,
have break, we can run into that, sure.
Okay, just real quick, it says competition for deposits. Would you say that the competition has increased in recent months compared with the second quarter? So since the end of the second quarter, have you seen deposit pricing really move in the quarter? And then they also asked, how do you expect to fund loan growth?
So yeah, I mean, clearly, you had a Fed move in June, which was not totally built into everybody's pricing at that point in time, and then of course in July as well, and one in September coming up. So clearly, we're seeing increases in deposit costs. There's also a little bit of disintermediation going on. People picking up treasuries, which they hadn't really done before. So deposit costs as a result have been intensified. But then again, I just go back to what the baseline in New York has always been very, very strong, and we do have. We are increasing our branch network. We are bringing in more deposits through our incentive structure, our revised incentive structure. So I think we'll be doing just fine in terms of increasing consistently with the loan portfolio. So I think we'll be watching the rate environment very carefully, obviously, and we'll respond appropriately with the right incentives. I think the advantage for us is, and probably something that is not well understood about the company, is we do have a fair amount of opportunity, let's say on the loan pricing side, and we sit in a very, very large market. So there's always enough volume to go around in this market, and we think we're in a unique position to take advantage of that with the 10 or so mergers that are in some stage of activity today.
Important point. All right, very good. Well,